So let's picture this. You've got the perfect business plan, you found that one piece of equipment that's going to take everything to the next level, you walk into your bank, the one you've been loyal to for years, and you ask for a loan, and they say no. It's a gut punch. So common and so frustrating for any business owner. But here's the thing, that no is absolutely not the end of the story.
And it really does feel like hitting a brick wall, right? But what if I told you that wall isn't really a wall? It's more like a signpost, one that's pointing you toward a much bigger road with a whole lot more options.
Because this is the approval rate you're looking at with specialist equipment finance lenders. Yeah, you heard that right. While banks might approve maybe 30 or 40% of these applications, the specialists, the folks who do this all day, every day, they say yes 90 to 95% of the time. Now that changes things, doesn't it?
So how do we get you from that frustrating rejection to a fast approval? Well, we're going to cover exactly why the banks said no in the first place, show you your best alternatives, lay out a clear path to getting financed, and cover the big mistakes you've got to avoid.
Okay, first things first, we have to reframe that rejection. It is not a judgment on your business or your big idea. Think of it as a common hurdle. For so many businesses, it's actually the moment they discover a financing path that's way faster, way more flexible, and honestly, just a better fit for what they actually need.
So why do the banks say no so often? You know, it almost always comes down to one simple truth. It's not you, it's them. It's not about your business, it's about their super rigid internal rules. They're not saying your idea is bad, they're just saying you don't fit perfectly into their very specific, very narrow little boxes.
And this right here, this says it all. This is the core difference. See, banks are obsessed with your past. They look at your credit score, how many years you've been in business, your old accounts. They want this long, perfect, predictable history. But specialist lenders, they focus on the asset itself and on your future. They're asking, what's this equipment worth? And can your cash flow support the payments? It's a total shift in perspective.
So let's break down their checklist. Banks are typically looking for a credit score over 720. They want to see at least 2, maybe 3 years of filed accounts. So if you're a newer business, you're kind of out of luck before you even begin. They get all nervous about bumpy cash flow, even if you're making good money. And they really don't like specialized or older equipment because, well, they just don't understand what it's worth. They call it asset risk.
And look, it's not like they're just trying to be difficult. U.S. banks are regulated by groups like the Office of the Comptroller of the Currency. Their entire system is built around managing all these different kinds of risk, credit risk, operational risk, you name it. It just forces them into this very conservative, one-size-fits-all model that frankly doesn't work for a lot of perfectly healthy, growing businesses.
So, if the bank's system is a no-go, what's the alternative? Well, it's time to look at the world beyond the bank, a world where finance is actually designed around the tools and the equipment your business needs to succeed.
Your main options usually boil down to one really important question. Do you need to own this piece of equipment when all is said and done? If the answer is a definite yes, then hire purchase is probably for you. If you need more flexibility, especially for things that get upgraded all the time like IT, then a finance lease is a fantastic fit. And if you just need something for a short time or a specific project, an operating lease is basically just a simple rental.
Let's dive a little deeper into hire purchase, or HP. This is the most straightforward path to ownership. You agree on the terms, you make your fixed monthly payments, and boom, once that last payment is made, the equipment is all yours. It's predictable, it's clear, and it's perfect for that core machinery or those vehicles you know you're going to use for years and years.
Now, a finance lease, this is where you get some incredible flexibility. The lender actually buys and owns the asset, which often means your monthly payments are lower. But the best part is at the end. You don't automatically own it. Instead, you get to choose. You can return it, you can keep using it for a super small fee, or you can even help sell it and get a piece of the profit. This is absolutely ideal for technology or anything that loses its value quickly.
And finally, we have the operating lease. Honestly, the easiest way to think of this is as a long-term rental. You're only paying for the wear and tear on the asset while you're using it, not its full price tag. So the payments are usually the lowest of all 3 options. It's perfect for seasonal work or that one-off project. When you're done, you just hand the keys back. Simple as that.
Okay, so now you know your options. How do you actually get approved? Well, the great news is that with a specialist, the whole process is designed for one thing: speed. Seriously, we're talking about going from a quick application to having that equipment delivered and earning you money in just a matter of days. Here's the playbook. It starts with you knowing exactly what you need and who you're buying it from. Then you gather up some basic information. You make that first call, and then the finance specialist does the hard work. They match you with the perfect lender for your situation. You get a quick approval, you sign the docs, and the supplier gets paid. It is a clean, fast, and efficient process.
And when I say fast, I mean fast. Just look at this timeline. You can get your application in on day 1 and have a decision often within 24 to 48 hours. From there, it's usually just a week or two before that equipment is on your site ready to go. Just compare that to the weeks or sometimes even months you could be waiting on a bank.
So here's the key to making this go at top speed: preparation. If you want things to move this quickly, have these documents ready to go. You know, basic stuff. Your ID, company info, a few recent bank statements, and the official quote from your supplier. Honestly, having this little checklist ticked off beforehand is the single best thing you can do to get a super fast approval.
All right, we have covered the why and the how. Now let's finish up with some really crucial advice on what not to do, because avoiding these common slip-ups is every bit as important as knowing the right steps to take.
The biggest mistake I see: people panic and start firing off applications to a dozen different lenders. Every single one of those applications leaves a little footprint on your credit file, and a bunch of rejections can really hurt your chances. That's why working with a broker who can find the right fit the first time is so key. Also, don't get tunnel vision on the lowest monthly payment. Look at the total cost. And please, whatever you do, never ever give up after just one rejection.
And this is exactly why you can't give up. I mean, look at this. The difference is literally night and day. Your odds of getting a yes from a traditional bank might be hovering around 35%, but when you go to a specialist who gets your industry and knows the asset you need, that number skyrockets to over 90%. You're not just improving your odds a little bit, you're completely changing the game.
So look, if there is only one thing you take away today, let it be this: a rejection from a bank is not the end of the line. It's a filter. It just filters out the wrong type of finance and points you directly toward the starting line for finding the right finance partner, one who's actually set up and even excited to help your business grow.
That no from the bank, it's in the rear-view mirror. It's done. The door to getting the funding you need is now wide open, and the odds are massively in your favor. So really, the only question left to ask yourself is this: what piece of equipment are you going to get first to really start driving that growth?